Hey guys, and welcome to my channel. This is Netastic Properties, where we talk a little bit about commercial investing and what it takes to get in. So instead of just letting me talk about my experience in the commercial real estate world, I'm going to occasionally put in some different folks so we can get their expertise on commercial real estate. So this series is where we talk to Rich Voller. He's a principal broker of Voller Commercial Real Estate in the Northern Virginia area. He's been doing commercial real estate for, I'd say, about 30 years, and he really knows what he's talking about. So he's going to talk a little bit about why investing in commercial real estate might be a better opportunity for some than investing in the stock market. So stay tuned. Make sure you subscribe. The point of this channel is for me to educate and present possible commercial investment opportunities to you. And if you don't have enough money to get into commercial real estate, make sure to go to my website and sign up. And if I can pull together a whole bunch of investors, I will gladly do that. So, okay, so stay tuned, and here is Rich Voller.
Hi, I'm Rich Voller, Principal Broker at Voller Commercial Real Estate, and today I'm going to talk a little bit about how you can make a lot of wealth in investing in commercial real estate and why I think it's one of the best forms of investment for long-term growth and appreciation. There's four main areas in which you can make money in investment real estate. The first one is through appreciation of the property, and those rates will vary, but you might get 5 to 7% a year in a good market of appreciation. You also have cash flow. If you're buying an income property like a shopping center or an office building and it's rented to one or multiple tenants, you're going to get cash flow. And a typical buy in this market, in this cycle, might be 7-8% return on your money. The third way is through the tax benefits of owning real estate. You're going to get depreciation on your other income. And that's calculated on the value of the building, not the land, and depreciated over a certain number of years. And you should talk to a tax professional to see what that rate of return would be for you. That could be sometimes 5 or more percent per year. And then the fourth thing is when you're buying a property, if you have a loan, you're paying down the principal on the loan. So it's a way of forcing you to save money and create equity that way. So if you add the four things up, you've got appreciation, cash flow, depreciation, and principal paydown. And let's take an example and add that up. If you get 5% appreciation and about 7% of cash flow, that's 12%. Another 5 on depreciation, that's 17%. And let's say 2% on principal paydown, that's 19% appreciation on your money. That's pretty good and hard to beat in the stock market or any other place. And then the last thing you're going to get from that sort of thing is the appreciation on the value of the property if you buy it with debt. So let's say you have $100,000 and you put that down as a 25% down payment. So now you're buying a $400,000 property, and the appreciation you're going to get is on the value of the property, not your $100,000. So for example, if you take $100,000 and put it in the stock market, and even if you get 10%, you're getting $110,000 at the end of that time. If you invest $100,000 in commercial investment real estate and you buy a $400,000 property, 10% appreciation is on the $400,000. So now you've made $40,000. You have $140,000 at the end of the day instead of $110,000. And that's through the leverage that you get from putting money down and borrowing the rest. So if you have any questions on this, it could be complicated. I'm an expert. I've been doing this for over 30 years. I'd be happy to talk to you. Give me an email, set up an appointment, and we can talk about how this might work for you. Thank you.